Financial accounting revolves around three main statements: the income statement, also known as profit and loss or simply P&L, the balance sheet, and the cash flow statement. Each serves a different purpose and contains important information about how a business is running. The income statement answers the question, how did the company perform throughout the period under consideration? Did it produce a profit or a loss? Typically, an income statement is prepared for a one-year period, but sometimes larger companies present it on a quarterly basis. The P&L statement helps us understand whether the operations of the firm created economic value. It also enables us to find important trends, such as revenue growth and incidence of gross profit on revenues. The balance sheet answers the questions, what does a company owe and own at a certain date? What is the company's financial position? It shows the assets that the business controls, the liabilities it owes, and the equity that belongs to equity holders. The reason it is called a balance sheet is because total assets must equal liabilities plus shareholders' equity. Assets stand on the left side of the balance sheet, while liabilities and shareholders' equity are on the right side. The statement of cash flows answers the question, how much cash did the company make during the period under consideration, and where did it come from? Given that income and cash generation are two different things, we need a statement that shows us the movements of cash, providing an idea of the liquidity generated by the firm's operations. You will find these statements in every company's annual report. Anyone who would like to get an idea about a business should start here.